Now I can see everybody. All right, folks. Now I should be able to see your faces when I ask questions. All right. So let's begin this. A couple questions to start this off. Have you lost money in the stock market? Your 401k, your TSP, your IRA? Let me ask another question. How much of your investment portfolio is guaranteed? Are you afraid of running out of money in retirement? Do you wish you could pay less in taxes? Here's another big question that we answer in this presentation. If there really was a system to eliminate all your debts, mortgage, credit cards, etc., in 5 to 7 years, would you implement it? Now let me ask you this, Maggie, John, etc., Luis. If you could do that for your clients, would you want to do that? If you could help your clients get completely out of debt, even after you've given them a new mortgage, in 5 to 7 years, do you think your clients would be interested in that? What do you think, John, Luis, Maggie? Maggie's shaking her head yes. Okay, so that's what we're going to talk about
right now. Trying to figure it out.
Okay, great. So a little bit about me. Again, my name is Eric Martin. There's my information. And this is my website, privateequitybanking.com. You can get a hold of me there at /calendar. So a little bit about me. I've got a Bachelor's of Science in Data Management. I've got a Master's of Science in Telecommunications, and I've also got an MBA. As you can see, I was a Marine. And when I got out of the Marine Corps, my first job was as the Vice President of Research and Development at Quest, which then became, was US West, then became Quest, now became CenturyLink. And I worked for all these companies over the next 10 years, usually in an R&D capacity. But basically, to put this into a nutshell, what we're talking about is a replacement for the typical banking process in America. John Adams had this to say about banking. He said, historically, usury was defined as any interest payment, whatever, on unproductive loan. Our whole banking system I have abhorred, I continue to abhor, and I shall die abhorring. James Garfield said, whoever controls the volume of money in our country is absolute master of all industry and commerce. I would say whoever controls the volume of money in their own home is also the master of all industry and commerce in their own home. Andrew Jackson said the following, you bankers are a den of vipers. I intend to rout you out, and by eternal God, I will rout you out. If the people only understood the rank injustice of our money and banking system, and by the way, it hasn't changed in 200 years, there would be a revolution before morning. So I'm trying to show you this revolution without any bloodshed. How's that? You'll recall, those of you that everybody here looks as old as I am, or I shouldn't have said that. I got white hair. I apologize, ladies. You don't look as old as me. But you look old enough to remember 2008, right? And the presidential debates, we had two senators, Barack Obama and John McCain. They were both asked the exact same question. Will you vote for the bank bailout? And I thought it was interesting because usually when you ask blue and red the same question in the presidential debates, they all give a different answer, right? Both of the candidates said, yes, but, and then they changed the topic to something else. In other words, both sides, red and blue, agreed with what the bailouts had to be. Again, not trying to make this political. Well, Janet Yellen did say in 2017, I don't believe we'll see another financial crisis in our lifetime. Maggie, you're chuckling. Do you want to bet me a Snickers bar that she's wrong? Yeah. So she then became the chief of the Federal Reserve. And she defended that $13 trillion bank bailout. They called it the stimulus package when she came in. But then when she was the boss in 2020, I looked up last year to see how many banks went under, and there were 5 of them. Yet we're told that banks are safe, right? And I think the most infamous one was Silicon Valley Bank. So just real quickly, the difference between 1929 and through 1933 during the Great Depression and what happened with Silicon Bank. What was one of the big differences there? Anybody?
They couldn't close the banks for days on end.
Exactly, which is one of the things they used to do. In fact, that was one of the problems. On Thursday, what ended up happening is this company called Founders Fund, which was a venture capitalist in San Francisco, they told some of their clients that they didn't trust SVB. Now, what happens when you send that kind of news out in Silicon Valley on Twitter and WhatsApp? Yeah, everybody's chuckling. You know what happened there. 8 million tweets went out in 4 hours. Wow. Yeah. And they lost $42 billion because $42 billion was pulled out of their bank deposits in just about the same amount of hours. That's why they crashed. See, we're not living in the same world we used to live in. Mark Twain put it this way: it ain't what you don't know that gets you in trouble. It's what you do know for sure that just ain't so. And so we believe that that the banks are safe and secure, or we don't see another alternative. I would argue the system is broken. Here's what happens with the average American family. So for every $1,000 you earn, and again, it doesn't matter if you're a doctor making $25,000 or a school teacher making $5,000. This is how we spend every $1,000 in the average American home. 40% goes to taxes, 34% goes to debt. And I know you loan officers are going, yeah, well, how come all my clients are at a 49% TTI? Well, okay, that's still the American average, 34%. We then spend 23% on our lifestyle, and 3% actually goes to savings and investing. We've been in this system for so long that it seems normal. But in my mind, that's a broken system. And so what I want to do is talk about how private equity banking can break the chains of debt and usury and taxes, right? Breaking us free from the money and banking system that Andrew Jackson talked about. I'll show you how you can eliminate all bad debt, finance your own lifestyle, never pay high interest rates again, and legally control and reduce your taxes. Now, this is a 4-part series, and today happens to be part 1. But what I'm going to talk about in this one, well, again, back to what Mark Twain said, it's what we know for sure that just ain't so. So I want to tell you, you actually can become your own family's bank. And you can create this banking account so that it goes on for generations after you. We're going to show you how to save money first and then spend it second. Show you how you can use your money twice simultaneously. And I know that probably sounds absolutely bizarre, but I'll show you how that's going to happen. So what is private equity banking? I look at it as a toolbox. Some people pitch this as an investment. I don't. I see this as a toolbox that I can then use to leverage better the investments that I want to get involved in. So it's a tool to control our own private financial condition. So we already looked at what the world is the way we are today. For the average American, for every dollar we earn, 75 cents of that goes to debt, usury, and taxes. And we get to put about 25 cents into savings and lifestyle. Like I said, I think that's a broken system. What if we could get to the place where, say, 50% or 50 cents of every dollar went toward lifestyle and savings, and 50% or 50 cents went toward debt, usury, and taxes? Would that be good? Christy shaking her head yes. John, what do you think? Does that work? Got people on mute. All right. What if we could get it to this? 75 cents goes toward lifestyle savings. Christy's whole face lit up. And only 25 cents.
That's even better.
That's even better? Well, and that's the question I was about to ask. So thank you, Maggie, for answering that question already. Would that be better? Of course it would. So let me ask you this then, Maggie. If 20% went to taxes, what would you do with the other 80% if you were completely out of debt?
Invest.
Okay. I put 40% to lifestyle and 40% to savings and investing. That's a good answer, right? Christy's shaking her head yes. You agree? You'd do something like that? Okay. Now, what about in retirement? And this is where it's going to blow your mind. You can use these tools to get to the point where 100% of what you're living on is tax-free and interest-free using this system, and 0 in paying taxes. Now, that doesn't mean that you might not still have investments that you pay taxes on, but this really is possible. You can have everything you do need to retire on. And is that really possible? Yes, it is. Now, there's one more step, and obviously, it goes without saying, at some point, we're all going to pass on. And when we do, what we can do is leave behind generational wealth, a family banking legacy, a family banking system that's free of usury and excess taxes. So this is what, by the way, what I'm going to show you guys today is exactly what the uber rich of our country, remember those robber barons that we heard about in high school history class back in the turn of the last century? That's what those families have done to preserve their wealth, the Rockefellers, the Kennedys, and others like them. Like I said, this is a 4-part series. Today we're going to go into the first part, and I'm going to go over what private equity banking is. Let me show you what the benefits of it are real quick, and then I'm going to show you how it works. So, by the way, this is not some get-rich-quick scheme. It's a new way of banking, so it's just a new system that you would use instead of the banking system. And the IRS, I want you to know, is okay with it. The IRS has approved it. I used the word sanction, and my wife said to change that, and I forgot to change it on this slide because she said sanction could be like get you in trouble kind of thing. So it's IRS approved, and it's called a cash accumulation account. And here's what you get with this private equity banking account. First of all the monies that you put in have tax-free growth and tax-free use of funds. So that's indicating that you paid your taxes on the money before you stick it in there, right? So you pay taxes now, and then it grows tax-free, and you have access to those funds tax-free the rest of your life. Think of this. Think of it as a 401k, but don't think of it as a 401k. Think of it as a 401k from the standpoint of the IRS has set some guidelines that if we do these proper things, we can have whatever the benefits are the IRS says we can get. That's what I mean by think of it as a 401k, but it isn't tax-deferred money like a 401k, and you also have tax-free use of your funds anytime you want, which is not like a 401k, so that's why I don't want you to think of it as 401k. But think of it as a framework that the IRS has placed out there that if we follow these guidelines, we can have tax-free growth of our money and tax-free use of our funds anytime we want. Also, liquid cash, anytime access, no age restrictions, and if you wanted to borrow money instead of like what we do for a living and charge closing costs, there are no closing costs. You just ask for the money and they give it back. Protection. You get special protections with this kind of a banking policy. You get it from creditors and lawsuits, unpredictable economy, and bank failures. Those are pretty good protections. Guaranteed returns with zero market risk. Again, like I said, think of it as a 401k, but don't, obviously, if you put your money out there in a 401k, it's at risk because it's just sitting in a money market, or not a money market, but in some kind of a mutual fund, right, through your employers. And that money is in the stock market, and that's not guaranteed. This comes with guarantees. You also get compound interest on all of the cash you stick in there and all the dividends that you get. Also, you get to have arbitrage. You get to use your money multiple times, and I'll show you how that works here in a minute in depth, and that's a very important part. And then the last one, you get to partner with organizations, insurance companies that have been in business for over 100 years and shown profits every single year for over 100 years. They're some of the safest organizations on the planet. Okay, so that's what I go over. In part 2, let me skip quickly to this, which will be in 2 weeks. Danya comes in and she gives a presentation about how to get out of debt with these tools. So I'm going to go over how the tool works. She's going to talk specifically about how to get out of debt using it. Why? Well, obviously our nation's $17 trillion in debt. And as I asked earlier, if I could show you how to eliminate high interest payments and all your debt in 5 to 7 years without earning or spending anymore, would you implement that system? And by the way, loan officers, this is something that I want you to learn how to ask all of your clients. So the idea, so that you can make some extra money, is that, say, a week after you've closed, you call back to Smith's and you say, hey, Jane, how about we do this with you? I already know your numbers. And by the way, this number of 5 to 7 years, you would be able to give an exact number because you'd already have all their debts that they gave you. You'd be able to plug those into a system, and you could tell them how quickly they could literally get out of debt. Let me ask you a question, loan officers. If you helped your clients, and this is a word that Mike said to me. He says, we like to kid ourselves that what we do as loan officers is transformational because we get people into a house. The reality is they see us as just a transaction. You know, they don't stick our little magnet business card up on the refrigerator and keep it there for 7 years just so they can call us the next time they want to refi, right? But if you helped your clients during that next 5 to 7 year period get completely out of debt, you think they'd remember you? Yeah. And do you think if you could get them out of debt in 5 to 7 years, they'd be ready to move into something different? A lot of times, huh? Yeah, not always, obviously. There's going to be those that say, yep, game over. I got my mortgage paid for. I'm completely out of debt. But a lot of people, they're still going to downsize or upsize, right? Kids leave and they're going to downsize or whatever. So this is what we want to, and that's what Danya goes over in the next one. Then in part 3, I bring in a CPA that used to work for the IRS. His name's Marvin. And he's going to show you how to reduce your taxes, reduce and control your taxes with proper business structures and income classification. So he will talk about the different types of money. I know we don't think of that very often, but property, rental property gets a certain kind of taxation, sales gets another taxation, dividend gets a different taxation. And so he talks about the different organizational structures that we can put together to lower the amount of taxes we pay legally. So again, that would be after Danya's, that's part 3. And then in part 4, I bring him back again, and we talk about how to convert our money from a forever taxed environment into a never taxed environment by looking at different buckets of money. So again, we've got ordinary income, dividends, rental, interest, capital gains, etc. All of that is taxable right now. Then we've got the tax deferred, like I said, the 401k, the TSP, the IRA qualified plans. But then we've got another bucket that's completely tax-free, and that's insurance, loans, death benefits, and some defined benefit plans. And the idea is to move as much of your money into this environment where it's not being taxed. Okay, so we call that moving your money from a forever taxed environment to a never taxed environment. So those are the 5 ones. So today's, again, part 1. So I'm going to talk about this is a powerful tool. You saw my interview right now with Mike. This is the emails that we bounce back and forth. He said, I told him private equity banking does those things that I already meant to you. And he wrote me back and he said, look, Eric, the big problem I see here is that it's whole life. I'm not a big fan of it at all. I'll look at it, but whole life is not a tool I'm a big fan of. And I said, Mike, I hate typical whole life insurance too. This is not typical whole life insurance. I then went on to say, attached is a video I made about private equity banking, how to 3x your real estate profits, real numbers, real examples. Any of you do real estate investing right now? Okay.
Not yet. I've just started. I'm
Okay.
part of AZRIA. So
Cool. Well, then here's just a picture of my front page. It's privateequitybanking.com. If you go here to my learning library, Maggie, you'll see that I have a bunch of different videos here. And one of them is this 3x your real estate investing income using private equity banking. So you can watch that video. That is the video that I sent to Mike, and it's out there on my private equity banking website. All right. So I showed him that. He watched that, and then he wrote back, okay, I'm very interested. So you're not actually opening a quote-unquote bank. You're creating the idea of one. And yes, that's correct. You're creating one that you can use for your own family inside of an organization that's an insurance company already. So I said, yes, exactly, Mike. That's why the New York Times calls private equity banking the secret of the affluent, because that's where they bank. Now, Mike isn't the only one. You remember Mike said I was kind of embarrassed that I'd never heard about this before? Well, here's another guy that had never heard about it, Tony Robbins. In his book, Money, Master the Game, he says this on page 448. He said, I had an immediate aversion to the words life insurance. Like most, I'd been sold retail life insurance, and I wasn't going to be taken again. It was his attorney that told him about this. And she wrote back, she said back to him, she said, Tony, this is not your typical retail life insurance. You can't just go buy this off the shelf. Think of this as an insurance wrapper. Again, the reason we call it a wrapper, why it's an insurance wrapper, she says to place around your investments. Because this is a place that the IRS has sanctioned you to put money where you don't have to pay taxes, and that's what helps them. So what's the difference then between a typical insurance policy, before all of you turn your heads off and go, not interested, just like Mike said, right? So this is a typical whole life insurance policy. It's 95% base. And base, by the way, is what the commissions come out of, and it's also what buys you death benefit, right? And you only get about 5% cash value. And so it's 95% death benefit, very low cash value, penalties and restrictions for 5 to 15 years if you try to touch that money, depending on the company. That's why I said to Mike, I don't like typical whole life insurance. This isn't. In this case, the base is between 10 and 35%. And the savings portion is between 65 and 90%. Again, depends on your needs, and I craft these individually for each of you. But it's properly structured. That's why I say I craft it for you. High cash value, guaranteed growth. Again, the word guaranteed. Compound interest, safe, flexible, tax-free, with dividends. So any questions so far? I know I kind of ramble. Okay, let me keep going then. Maggie, any for you?
I'm good. I've been researching private banking for a while,
Mhm.
so this is definitely something I was looking into.
Okay, well, hopefully I can explain the mechanics of how this works. So this is where you got to put on that thinking brain for a second. And I apologize, I'm going to kind of get into the weeds, but you need to understand the math kind of behind this and how this works. Okay, so again, not to confuse you, but back to typical whole life. This is how it would work on day one. You got your premium plate, you got your cash value plate, and you got your death benefit plate. And in this premium plate, if you put in $100, you'd have $5 in cash value. Oop, big whoop-de-doo, right? And then you get your death benefit. That is a typical one. So it's a low cash value, and it has restrictions on getting at that cash value. And again, this would be day one. That's why I don't play with those. But if you've got a whole life insurance policy, which is a private equity banking account, you put in $100, about 60 of that, like I said, 60 to 90%, but I'm going to try to be conservative. 60% of that is going to go toward savings. So again, it could be 60, it could be 80, it could be upwards of $90 of that 100 is going into what's called the cash value. And you then have no restrictions on that cash value. Notice up here I put day one. Really, it isn't day one. They wait until the check clears, but let's just say within the first week you can get your hands back on that cash. Does that make sense? Okay? And then you can take out insurance loans from the insurance company. And then you also get a component that would be the death benefit. Now, let's say that you get to the point where you've got $2,000 in target premium. That would give you about $1,200 in cash value. You get your death benefit, and then you could pull out $1,200 in a loan immediately. Again, I put day one just so that you understand there's no restrictions like a typical insurance policy where it takes a while to get it, like 5 to 15 years. You'd have access to it because it's still your money. Again, they're going to want to see that the check is cleared, but you'd have about $1,200 available to you in an insurance loan. Now, here's where this gets interesting. This is why I said you get to use your money twice. Your money in here is going to be growing at about 5%. The reason I put 5% is because there's multiple companies that do this. There's about, there's about 8 that do it. I play with about 5 of them. But they all pay out right now about 5%. In writing, guaranteed. And if you want to borrow, the difference is usually about 1%. Sometimes it's less, sometimes I've never seen it more than 1%, so that's why I've left it like that. Okay? So the difference between those two is obviously 1%. Here's what's cool. When you ask for a loan, you're using this part here as collateral, and they're giving you a separate pot of money for this. Does that make sense? You're borrowing this from the general fund of the insurance company. So your $1,200 is still earning 5% even when you borrow at 6% from them. That doesn't go down. Does that make sense? So really, you're paying the difference between them, which is about 1%. All right. So let's say that you get to the point where you've got $1,200 at 5%. Over the year, they're going to pay you $60. And if you borrowed that money at $1,200 at 6%, obviously they would charge you $72. The difference there, $12 or 1%. Is 1% or less an excessive interest rate for any of you? Christy's shaking her head no. Maggie's shaking her head no. So as loan officers, you're okay with paying 1% interest? Everybody's shaking their heads yes. Okay.
Yeah. So your 1,200 is still there earning interest.
That is correct.
I mean, because you just took a loan, but it's from the general fund, or how does
The
that work?
general
You take
fund
a
of the
loan
insurance company. That's correct. Your personal savings account with them has $1,200 in it, and it still is earning 5%. They
It's still
never
earning the
reduce that.
interest. Okay.
Isn't that cool? And this is where the math comes in to where you can wipe out your debts quicker. That's why I say you can help your clients get out of debt in 5 to 7 years. Why? Well, I'm sure they got a couple credit cards. Let's say the credit card's at 29%, which is the most that most can do. They're paying $348 in interest that year, right? Is 29% excessive interest or usury? Christy's
Yes.
shaking her head yes. Maggie says yes. Okay, exactly. That's the whole point. And so, should a person borrow from the insurance company to pay off their credit card? Mathematically. Does it make sense? Exactly. Because how much are they really saving? Those two cancel each other out, and it goes $348 versus $12. So their savings $336 that year. I know you're going off $336, big deal. But if you add that over all their credit cards and over the time it would be running, you get to see quickly how people can get out of debt. Okay? So let's add a zero to that. Let's say instead of $1,200 in their savings account, they now have $12,000. At 5%, they're going to earn $600. That $12,000 that they borrow back at 6% is going to cost them $720. But if they had a credit card with $12,000 on it, they're paying $3,480. When those two cancel each other out, you got 1%. They're paying $120. Is paying $120 for $12,000 worth of money a good deal? Yeah.
What do the repayment terms look like for the loan?
I will pay you for that question later, Christy. Thank you for asking that. That is a fabulous question. I'll interrupt myself right there to answer it. The insurance company, remember that component that's still over here that it's not showing on the screen right now, Christy, of death benefit? Okay. That is really what the insurance company cares most about there, right? Because let's say that that's you, Christy. I'll just use you as an example. See what you get for asking me questions, right? If they have $1 million insurance policy on you over here, are they worried about the $12,000 you just borrowed?
I mean, got to worry about every penny when you're, but I don't,
But what are they insuring here? What are they insuring with the death benefit? And I know that's a simple question, and it may sound condescending, but I'm trying to step you through it one at a time. What are they actually insuring?
insuring your life.
Exactly. So they're insuring Christy. Are they worried about Christy not paying back that loan?
No.
No, because if Christy dies, which would be the worst case scenario, right? What do you think they're going to do with that $12,000 before they give your significant others the $1 million death benefit?
Are they going to back it out?
Exactly. They'll take out that 12 grand. So your heirs get 999,900 and whatever. You're less 12 grand, right? Does that make sense?
So can people pay it back if they choose to?
Yes. And that was what I wanted to say. So what we give people as loan officers, and we seldom use this term, but they are scheduled loans, right? They're not they're and I know we all know this stuff, right? Sorry, don't want to sound condescending to loan officers, but when you get somebody a mortgage, they owe a mortgage every first of the month, right? Bingo. So that is a loan that must be paid back on a calendar basis. These do not have, they're called unstructured loans because there is no structure to them. So Christy, if you want to pay it back, you make normal payments. And I tell people you need to be, and I know this is going to be an oxymoron, an honest banker with yourself. So if you do have out a loan, you do need to pay it back. But if you don't pay it back because it's an unstructured loan, is there any problem with that with the insurance company? Exactly. No, there is not. Because they've got your death benefit to, and they've already calculated how many women your age are going to pass away this year. And they're not worried about you making a repayment. I know that was a long answer. But does that answer that question, Christy? Then I'll go on to yours, Maggie.
Yeah, it does. Yeah, I do have some more questions, but
Okay.
not right now.
Okay, Maggie, let's go with yours.
Oh, Maggie.
Well, okay, so if you choose, you know how, like how, so we have a loan through the bank, say for example, an auto loan.
Mhm.
We have to pay them, right? So wouldn't it make good financial sense for us to pay ourselves back, like how we pay?
You two ladies are great. I'm going to have to give you both a bonus at the end of this thing. Yes, in fact, you want to pay yourself an honest rate. And if any of you ever get together one-on-one with me and do a present, and I can show you a spreadsheet that I've built, but I show you how to become an honest banker with yourself or with others. I'll give you a quick example and then I'll roll forward. I think this will explain it. My children, about a year ago, I was out in my front yard and my neighbors were having a yard sale. And I overheard a gentleman ask my neighbor why he was selling all this good stuff. And my neighbor said, well, I'm getting out of the Army and my wife and I have bought an RV and we're just going to travel out around the nation. So I don't need all these toys and junk. He was weightlifting gear and stuff like that he wasn't going to put in an RV, right? So as soon as that gentleman left, I walked over to my neighbor and I said, hey, Jason, I overheard you say you're moving. Have you guys put this house up on the market yet? And he said, no. And I said, well, you're in the Army. Did you get a VA loan? He goes, I don't know. And I said, I bet you did, and I bet you it's assumable. And he goes, I don't know. You'd have to ask my wife. And I said, okay, well, if it's assumable, my kids are, my daughter and son-in-law are both in the Army. Could they assume your loan? How much do you want for the house? He told me the price. And I said, okay, and when did you get the loan? He told me. And I said, so you're probably in the 2.5 to 3 range, right? And he goes, yeah. And I said, can my kids assume that loan? And he went, yes. So, make the long story short, I quickly called my daughter and said, come look at the neighbor's house. I think you guys can assume it. We'll just do a contract with them. And Mom and I are willing to loan you guys a bridge loan until you sell your house. So, Maggie, we went and pulled money out of my account, right? And I'll give you the real numbers. With my account, I had to pay 4.76. So we loaned that money to my kids at 5.5. Was that a fair deal for my kids? Okay, I got loan officers shaking their heads. Yes, some of them get upset at me. How dare you charge your kids money? Well, you get the idea. But yes, I took then the 5.5%, and I paid that all back to myself, Maggie, because they put their house up for sale and they sold it like 4 months later. And as soon as they sold their home, they had equity in it, and they paid us back. So not only did I pay the loan back, Maggie, but I charged a little extra interest on my kids so that I would be an honest banker. Does that make sense? But no, back to Christy's question, I did not make any payments during those 4 months. I borrowed about $40,000, and for 4 months I let the $40,000 just sit there. I didn't pay anything back because I knew as soon as they paid their home off, I would get all my $40,000 back, which I did. So I think that kind of is an example to both of those questions at the same time. But Maggie, did that answer your question? She's shaking her head yes. Okay. Is that cool?
Yes.
Okay. So that's how this process works. My money was still growing, and by the way, mine was growing at 4.25, and I was borrowing at 4.76, so I was borrowing at half a basis point, folks. 50 basis points. Not bad. That's even better than the 1. Those are my real numbers, by the way. Okay, so let's continue on with this. Let's say now that you've got enough to buy a car. You've got $52,000 sitting in there, earning 5%. That's $2,600. You could borrow that money from the insurance company and pay them $3,120. So you're now paying 1% on $52,000, which is $520. Versus if you went out and got a car loan, I don't know, 7.5 about right for a car loan right now. Yeah. So that'd be $3,900. The difference there, I'm saving $3,380 a year by borrowing that money for myself, by becoming my own bank. Does that make sense? Okay. Now on to the question that I think you were asking a minute ago. Let's say that you had $250,000 in there. Don't freak out and go, oh my gosh, when am I ever going to have $250,000 in the bank? I'll show you. It doesn't take that long to get there, right? But again, let's say you're a real estate investor. Maggie, you just said that you're getting into this, right? And a lot of people that flip homes have that kind of money. Again, I'm making the point that this money could be available to you on week 1. And yes, I have helped people build these policies where they dropped in up to $1 million on day 1, right? But if you wanted to go borrow $250,000 for a fix and flip, right, you could borrow that $250,000 at 6% or 15 grand. So the difference there is only $2,500. If you're doing fix and flips, Maggie, and needed $250,000 for 1 year, would paying $2,500 in interest be a good deal?
Yes.
Yeah.
Definitely.
Yeah. Instead of, I don't know what the market is today, but let's say it's 12%. That's 30 grand.
Typically
Right.
12, yeah.
Yeah.
I have a question, Eric.
Yes, ma'am.
So if you're doing this, you're borrowing money from yourself, basically. Is this going to show up on a 1003?
it can show, you can show this money to qualify for a home. And yes, Diane and I did that. So we sold our home in one state. We moved to a new state. We dumped, I think we had about 140,000 in equity immediately into my policy, and we got here to Texas and we pulled out about 80,000. We were able to show UWM that we had 140,000 in equity there, and we pulled it out. And so they were willing to take it. I don't know if that's the question you're asking there.
Yeah, I'm just wondering if you have to, consider that in a DTI or no, because it's a policy and you don't have to repay it.
I see. From a loan standpoint, no, it does
Loan
not
standpoint.
show it. From a loan standpoint, you do not have to pay it back. That is correct. So it's not showing, it's not hurting your DTI. In fact, there's another
Okay, so
place.
it's just like cash available. Okay.
Yeah. And another place where people use this, Christy, is with kids that are heading off to college. What people will do if they have a lot of equity sitting in their home, whether they put it in originally or whether the house is just increased, when you fill out that FAFSA information, as you may know, they look at all that and they go, oh, well, mommy and daddy have 300,000 in equity in their home. They need to pay a larger percentage of your college, right? Because of FAFSA. So a strategy that some people use is to go and borrow. Can't do it here in Texas because we're the only state that plays daddy on top of us. But in all the other states, you could go and get a refi, pull out a whole bunch of cash, then take that cash and shove it into one of these policies for the 4 or 5 years that your little girl is in college, and it doesn't harm you from a FAFSA standpoint. You now have 300,000 in cash sitting in an insurance company, but it doesn't show up on a FAFSA. And that's another thing that's important too. In that last class that I talked about, that I do with Marvin, the guy that used to work for the IRS, it's a CPA, he also points out that the monies that you have sitting in these accounts are never reported to the IRS either. So they don't know how much cash you've got sitting there either.
At what age do you suggest people start setting one of these up, and what is the minimum, or am I getting ahead of you?
No, please ask. Like I said, this is for you guys, so ask the questions you want. So 2 questions there. When do I suggest people do it? You must be over the age of 18, and you must be earning income. So usually that's kids that have gotten out of college or have a VOTEC and they're getting a half decent income. So let's just say normally they're in their 20s to 25s when they can begin these things. That's when I would suggest you do it. I didn't find out about this until I was 50, so that's when I got mine. So
I'm just thinking about for my kids. I'm an empty nester, so
yeah. So and here's another thing you can do too, Christy, is and I've done this for a lot of people, is you can help your kids get a policy. You can still be the owner of it, so you can funnel monies into it. You can use those monies. And here's one of the cool things about it. You can then transfer it over to your kids. If you insured your kid's life and you were paying for it, but then the beneficiaries ultimately become your grandchildren. So again, just different strategies on how to make this happen.
And are these held
Okay, well, that was-
typically in trust? Would we put ours in our trust?
Yes, ma'am. So Diane and I have ours in the trust, and really, if I died tomorrow, and you're going to see here in one of the next slides, you'll see my actual policy. I think I've got 1.2 million or something on my life. If I were to die in an accident this evening, that money then goes into my trust, and then our trust dictates how it's spent with our children and my wife. Mm-hmm.
Okay.
Maggie, you were saying something, I think?
Well, I actually had a question.
Mhm.
So basically, when you mentioned something about, having your children do a policy, and then you be the owner,
Mhm.
can you do it with your grandchildren? Or no?
Well, again, they have to be over 18.
You have to be over 18. Okay.
And yes, I do have policies on my grandkids, but they're more like that traditional one I showed you in the very beginning that I said I don't like.
Oh.
They won't let you do a high cash value one on anybody under 18.
Okay. So as long as they're 18 and above, then
You can do this. So for
and they have to
example,
have
a gentleman that I'm working with currently he's 78 years old. So he's at that point where getting a life insurance agent or a life insurance company to give him a policy probably isn't going to work at age 78. But he owns a property that he rents out, a big warehouse that he rents out, and he makes about $30,000 a month on the rental income on that thing. And so what we're doing is we're taking that 30,000 and we're dividing it amongst his children. I think he's got 6 or 7. I don't remember exactly at this point. I think it was 6 kids, and we're dividing that 30,000 amongst them. And he's going to be the owner of that policy while he still lives. But when he dies, it goes into his trust, which then his wife would control if he precedes her in death. And then after that, the trust that Christy was just talking about that we're creating with him, that trust owns that real estate, and the trust continues to pay those policies on all of his children. And then the trust has stipulated how his children and grandchildren can borrow against the monies that are in there. So let's just say one of his children were to pass away, that trust is going to get an infusion of about $1 million plus in tax-free money that now the family organization can borrow against. Forget about just the fact that he's putting in $30,000 a month times 12 months a year toward building cash value for his kids. But now see how he's building a legacy for his whole family, a banking legacy.
Makes sense.
Yeah. All right, let me keep going with this. So again, fix and flippers, they get this kind of stuff. So instead of spending 30,000 on interest, they'd be saving about 27. All right, so back to how this works. You put $100 in, you get 60. You can have that available to you in 60. Now, there's another concept, and that's why I said these things have to be built properly. This is called paid-up additions. And usually, I can squeeze about 3x more money into paid-up additions than I can the target premium. And don't get wrapped around all these terms I'm using. Just think of paid-up additions as the extra savings that you can shove into these policies. So there's an extra $300 there. So now instead of only having $60 in there, you got $360. And whether that's monthly or annually, it doesn't matter to me. Again, the concept of how much is going in there. And by doing that, by putting in an extra $300 here in paid-up additions, you're going to get about $900 extra in death benefit. Okay? And if I've confused everybody there, let's just sit down one-on-one and I'll walk through it. But what this is this isn't a way that we can shove extra money into this without the IRS going, hey, wait a minute, that looks like a savings account, not an insurance policy. Because that's basically, remember I said at the very beginning, these are IRS guidelines that we have to follow. And if we exceed those guidelines, in other words, we put too much money into it, then the IRS says, wait a minute here, this waddles and quacks like a savings account, and we're going to tax it like we would normally do a savings account and not an insurance policy. That's why I say we have to follow their guidelines. And where that came from, by the way, was back in the 80s. Any of you are old enough like me to remember the S&L scandals in the 80s? And remember the old saying, the best way to rob a bank is to become a banker? And those guys owned their own banks, and they were out there borrowing money with their own companies against their own banks and stuff like that. Well, another thing those knuckleheads were doing was they were borrowing that money, they were shoving it into an insurance policy and saying, oh, it's an insurance policy. And there were no caps on how much they could shove in there, because insurance had been around for 150 years before the IRS even existed in the United States. So there were no guidelines on insurance, and they were just basically creating what they called an insurance policy to get the tax benefits out of it and then having huge amounts of money in there. Anyhow, I'll go on. So yes, we are capped at about 3x on the savings portion. Okay, now this is my real policy. Like I said, I didn't figure this out until I guess I was 55. But it's now I've had it for 4 years. Here's something I want to show you. It's saying that my policy should have $199,000 in it at the end of this fiscal year for me, which, by the way, is in October. So what it's saying is that in October, I should have $199,000 in my savings account. But I pulled my policy, as you can see, as of on January 30th of this year, and you'll notice the amount that I had there, $220. Why do I have more money in there after 4 years than what they had illustrated for me?
I thought you mentioned the dividend, no? What is
Yeah.
that? Is that including a dividend?
That is including a dividend, but this number here was also including the dividend.
Is that because you were borrowing it and paying yourself
Paid
back?
it back?
It's because I was paying my paid up additions up front.
Okay.
So you see, I can
Oh,
put 60,000 in a year. What I do is I shove 40 of that up front. I try to. The year prior, I try to save and have 40 sitting there, and on day one, I fill the the PUA portion, the savings portion, as fast as I can, and then I let them pull out the rest of the insurance portion during the next 12 months. So now I'm earning more money over time. But anyhow, so that's the paid up additions, the savings side of it. Okay? All right. Now, this is a real example. This is a 35-year-old male who's putting in $1,000 a month or $12,000 a year. In year 10, he will have put in $120,000 in premium. Okay? Now, he's got the ability to put in an extra $200,000. And I always suggest to people that they put that in and then borrow it right back out, because now it's earning interest for the rest of their life. Does that concept make sense? Okay?
Yeah, as
So
long
he
as
could,
you have the cash.
well, do you know anybody that's not making $1,000 a month, Christy?
Well, no, I mean I meant the extra 200.
But he's not. No, but he's not leaving it there, Christy. That's why I asked if the question was meant understood. So thank you for asking that again. He puts that 200 in there. So let's say that he, that's what, 3,000 a month. But he pulls back 2 of it every single. Puts it in. The check clears, and he pulls back out 2 of the 3 that he just put in there. Does that make sense?
I see. Yeah. But you still have to be able to fund it up front, even if you're bringing it back.
Even
So,
if you're pulling it
okay.
back out. Yeah.
Yeah.
Exactly.
Yeah, got it. Okay.
But that's the concept that I try to show people, is that you have the ability to let this thing grow. Because at age 35, what are the odds of him making more money as life goes on, as his skill sets improves and as he gets promoted, right? So at some point he could pay that stuff back, but at least it's shoved in there and it's earning him money. That's the point. Okay? So that extra money, again, he throws in that extra $600 or $600,000 that there. $200,000 that year. Look what it does to his death benefit. It takes it from $2 million to $2.6 million. And by the way, since this is whole life, unlike term, it never ends. So by putting in an extra $200,000 at age 35, he just gave himself an extra $600,000 in death benefit that will go to his heirs. Period. End of story. Because this is what it normally would be, and this is what it would be if he shoved in the PUA. The reason that the death benefit has to go up is because one of those IRS rules says that the insurance company has to give you a proportional amount of death benefit to all of the premium you pay.
Okay, so in this example, tell me if I'm way off the mark. So the target premium of 120, that costs him 12 a year?
Yep.
Or he's putting in
Yep,
120?
it cost him 12 a year. We're just using
All
that.
right, so if he puts in, if he puts in an extra 20 a year, then
Yep.
that brings him to the total premium value of 320, even though it cost him 3,200.
Exactly. At year 10. So this is accumulating it over 10 years. Yeah.
Right. Got it.
And so we got an extra $600,000 in death benefit, and then the loan here, well, 558 to be honest. And then how much has he borrowed? Who knows? But he has 355 available to him. So he's put in 320 and he has 355 available to him. Isn't that cool? All right, let me keep going. So with 355,000 in cash at age 35, how much of a lifestyle could he finance at less than 1%? Because what could he do at age 35 if he had 355,000 available to him? Is that super undoable for a kid but age 25, putting in that much? And by the way, I'm using a real customer's numbers. You asked me earlier, Christy, at what age? So I've got a 25-year-old that started a policy, and he puts in $1,000 a month right now. He's single, doesn't have any kids. So he's like, yeah, I can put $1,000 away each month. But this is what he's trying to do right now because he's seen this and we modeled it for him.
What is the minimum, say for kids in their 20s who, maybe can't put 1,000 yet? Is there a minimum? Is 1,000 a month the minimum?
No, it is not. In fact, I just did one for another Nexon right now. She got approved today, and I believe her payment is like $350 a month. But it can be as small as $100 a month. They don't care. And by the way, you can outgrow that and then get another one, right? And then outgrow that one and get another one. But yes, once it's created, we can't add to it, if that makes sense, Christy.
That was my
Okay.
next question.
That makes sense. Okay.
Yeah. So think of this as I'm building a boat, a custom boat for you, and you come to me and you say, I need a gas tank that can put $1,000 in every month. Once that's built, that $1,000 plus whatever we put in the PUA, which would be like a reserve tank, that's the max you can put in. So if you hit the lottery or you get a better job and you graduate from college with that PhD in brain surgery and now you're making tons of money, you still are stuck with whatever we built in the beginning. We can build you another boat, but I can't shove more money into this boat or it becomes a taxable boat, and we don't want it to be taxable.
Okay, that makes sense.
So, I'll give you another example that might help that along. My wife inherited some money from the passing of her parents, and due to our age and her health, we didn't want to insure her. Well, we couldn't insure her, so we asked our oldest son if we could insure him. The policy on him has a $3 million death benefit, but he can qualify for $25 million. So that was one of the questions he asked us. Well, can I still get insurance on myself if I want it? Yeah, he can, because he can still qualify for $25 million in death benefit, and we got a death benefit of 3, so he still has 20 some odd that he could go do on himself. So. But yeah, there are limitations on how much death benefit an insurance company will give you. All right, so same kid, year 20, same kind of concept. He can put that away, and now his cash value is $916 that he could borrow. And by shoving the extra money in, he now has $3.5 million in death benefit instead of $2.6. So this is building up for all of that cash, tax-free when he passes, that would go into that trust that you were talking about, Christy, and help the family. Age 55, now he's been doing this for 30 years. Again, I'm not going to belabor these points, but again, if he had started at age 55 and was just shoving this in there as such, even though he borrowed back against it, he'd have $1.5 million available at less than 1%. What could a 55-year-old invest in if they had that $1.5 million?
That's me today. I wish I could.
Yeah, exactly. And that's why when I found this out, I was like, wow, I got to get involved in this. This is cool. So, age 40, boom, boom, boom. Again, the same thing. Now $2.5 million in just 10 years. It's increased by over $1 million. All right. So as I said, one of the points is to get you to zero. So if this young man did this for 40 years, he'd have $2.5 million. Let's say he wanted to live on $120,000 a year by borrowing back against it. How much is he going to pay in taxes on that $120,000 that he's now pulling out every year, starting at age 65?
Zero, right?
Yeah, because it's a loan. Loan officers, do you get paid? Do you have to pay tax on a loan? No, you don't, right? And so if he decided to supplement his income, he wanted to be a greeter at Walmart at age 65, how much would he have to pay in taxes to clear 120? Yeah, a whole lot. You get the point. So that's there. Yeah. And so, would you keep paying into this policy? Yeah, I'd keep paying the $12,000 in every year, even if I borrowed it and paid it right back, you know, just so I could keep this thing growing till I was 75. All right, 50 years into this bad boy, 60 years in, I think I've belabored this point. And then at death, let's say he passes away at age 85, he has a $6 million death benefit, but he's been borrowing for the last 20 years. $120,000, so that's how much he owes, right? So they're going to take $1 million away from him and leave his family the difference. So they take out the insurance loan of $1 million. He still leaves his family $5.2 million. Did I go too fast through that point right there? Pretty simple, huh? Yeah. All right. And this is the one I was talking about. That gentleman, this is just an idea of it, that he's got more kids and then the grandkids and how they're splitting it up. These are families that have used this policy, that have used this concept, and companies. If you ever watched the movie about Ray Kroc with McDonald's or the Pampered Chef, both of the owners of these two, Ray Kroc and the woman that did the Pampered Chef, they both borrowed from these policies to build their empires when they were, you know, older. So back to what Mike said. Debt elimination is not transactional, it's transformational, and if all you do is help your clients get out of debt, I think you've done something fabulous. We've run a bit over today. I apologize, but I've loved all of your questions. What else can I answer for you folks?
So so how often are the other webinars in this series going to be? Are they weekly?
No, they used to be weekly, but next I moved those back to bi-monthly. So now the one that went today, part 2 will go in not next Tuesday, but the week after that.
Okay.